On the one hand, I think Mark is right. Crypto's been disappointing because crypto should move with, equity markets, and it should be rallying with software. Software has really started to rally big and crypto hasn't moved. So I think there are what I call, quote, rage quitting, people selling here as if something is wrong. I think that's what always happens at the end of crypto winter. If someone asks me, is the thesis for Bitcoin or Ethereum broken? It's absolutely not.
Bitcoin has suffered one of its sharpest drops in weeks, crashing below the critical $70,000 level and triggering widespread panic across the crypto market. In just a matter of hours, the world's largest cryptocurrency plunged nearly 4%. Wiping out billions in market value and unleashing a liquidation cascade that erased more than $760 million in leveraged positions. The move caught many traders off guard, especially after Bitcoin had spent months consolidating above this key psychological support level. Several major catalysts appear to be colliding at once. Rising geopolitical tensions surrounding the growing conflict between the United States and Iran have pushed investors toward risk-off positioning. At the same time, Michael Saylor's strategy shocked the crypto industry by disclosing its first Bitcoin sale in years, breaking a long-standing narrative that the company would never sell its holdings. Meanwhile, Bitcoin ETFs continue to bleed capital at an alarming pace, with billions of dollars leaving funds over the past 2 weeks. Together, these developments have sent sentiment tumbling back into extreme fear territory. But is this simply another temporary panic event, or is something much bigger happening beneath the surface? In today's video, we'll break down exactly why Bitcoin is suddenly crashing, examine the surprising moves by both Strategy and BlackRock, and discuss whether ETF outflows are becoming a serious threat to the current cycle. We'll also hear from JPMorgan CEO Jamie Dimon as he vows to fight the Clarity Act and challenges the crypto industry's push into banking. And later, we'll look at a fascinating interview with Fundstrat's Tom Lee, who explains why stocks continue pushing higher while crypto remains stuck in neutral despite some of the strongest long-term tailwinds in years. If you enjoy in-depth crypto market analysis that cuts through the noise and focuses on what actually matters, make sure to hit the like button, subscribe to the channel, and let us know in the comments, is Bitcoin's drop below $70,000 a buying opportunity, or the start of something much bigger? Now let's get into it. The immediate trigger for the latest sell-off appears to be a combination of deteriorating market sentiment and a series of headlines that arrived almost simultaneously. As Bitcoin broke below support, liquidations accelerated rapidly. More than $646 million of the $766 million liquidated came from bullish traders who were betting prices would continue rising. Instead, they found themselves caught on the wrong side of a fast-moving market. One of the biggest surprises came from Michael Saylor's strategy. For years, Strategy has represented the ultimate Bitcoin conviction trade. The company effectively built its identity around accumulating Bitcoin and refusing to sell. That's why markets reacted so strongly when regulatory filings revealed that Strategy sold 32 Bitcoin near the end of May, raising approximately $2.5 million to cover dividend obligations. To be clear, the sale itself is tiny relative to Strategy's overall position. Even after the transaction, the company still controls more than 843,000 Bitcoin, making it by far the largest corporate holder in the world. The issue isn't the amount sold. The issue is the message. Investors had grown accustomed to viewing Strategy as the market's most unwavering Bitcoin bull. Any deviation from that image naturally creates uncertainty, especially during an already fragile environment. At the same time, ETF flows have become an even bigger concern. What helped fuel Bitcoin's historic rise is now working in reverse. Spot Bitcoin ETFs have recorded their longest streak of net outflows since launch, with billions of dollars leaving funds over the past several weeks. Large-scale redemptions create persistent selling pressure, particularly when institutional investors begin reducing exposure during periods of heightened uncertainty. BlackRock's iBit fund has drawn particular attention after accounting for a significant portion of recent outflows. While some market participants have suggested that BlackRock is somehow intentionally suppressing prices, the reality is likely far less dramatic. ETF managers typically respond to investor demand rather than dictate it. The more important story is that institutional appetite has clearly cooled in the short term, and until those flows stabilize, Bitcoin may continue facing headwinds. While Bitcoin investors are focused on price action, another battle is quietly unfolding in Washington that could have major implications for the future of crypto adoption in the United States. The banking industry is drawing a line in the sand against the Clarity Act, and leading the charge is one of crypto's most vocal critics, JPMorgan CEO Jamie Dimon.
We're not worried. We think it should just be fair. If he takes deposits like a bank, he should have bank rules. We have social requirements, liquidity requirements, capital requirements, AML requirements, financial reporting requirements, transparency requirements. If he wants to be a bank, be a bank. That's all it is. And the second issue, not really related to rewards and interest on stablecoins, is also about AML, BSA, KYC, because when you earn a bank system, it's already been through all of that. Okay? And we do that because we have to for the federal government. And so if they want to be moving money around the world on any basis, you should ask the question, can that be used illegitimately, easily? And the answer would be yes, unless they follow the same rules.
Right. They're not FDIC insured.
And they're not FDIC insured. We have requirements to build branches in lower income neighborhoods. We have liquidity requirements and capital requirements, reporting requirements. We have like 84 regulators all over us. We're just saying it should be fair and equal, period. Not that they can't do what they want to do. If you want to buy cryptocurrency, be my guest. I believe it's a free country, and I defend that right. But we just want it to be fair.
So, are you happy with the way the Clarity Act is turning out?
No, because it allows them to effectively pay interest on deposits, stable coins or something like that, without the protection that they should have. And it doesn't do anything for AML, BSA. It has almost no legal protections. So no, the banks will not accept it that way. And the ABA, the small banks, the credit unions, it's not just the big guys. I'm not worried about stablecoin, but if it happened, I'm telling you, I would have nothing to do with it, and it would eventually blow up on its own. Okay, but that's my personal thing. But I do understand the concern of all the other banks. So,
well, the markup is coming. I mean, what are you going to do about it?
It is. We'll fight it. If we lose, we lose, and we'll live.
Yeah. Okay.
But it will be fought. This will not be. No one's going to bow down to this guy, okay, or that company. And he's the only one.
Yeah.
And he's spending hundreds of millions of dollars in Washington this thing.
Okay? He said he's representing the whole industry.
He's full of shit.
Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit, you could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth, tax-free. You keep the full $50,000, same crypto, completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time. Jamie Dimon's comments reveal just how serious this fight has become. The banking industry isn't simply asking for regulatory clarity. It is actively attempting to shape what that clarity looks like. Banks argue that allowing stablecoin issuers to pay interest or operate in ways similar to banks without equivalent oversight creates an uneven playing field. Crypto advocates see the issue very differently. They argue that traditional financial institutions are attempting to protect their market dominance by lobbying against innovations that could reduce their control over payments, deposits, and financial services. That's why the Clarity Act has become such a high-stakes battle. It isn't merely about regulation, it's about who controls the future infrastructure of money. Dimon's direct criticism of Coinbase CEO Brian Armstrong underscores just how personal and political this debate has become. Although the banking industry lost the first round when the legislation advanced through committee, the larger battle is far from over. The next stage could determine how crypto and traditional finance coexist for years to come. At the same time this regulatory battle is unfolding, investors are facing another frustrating question. If stocks continue climbing and artificial intelligence remains one of the most powerful growth stories in modern history, why has crypto struggled so much? Fundstrat's Tom Lee believes the answer has less to do with broken fundamentals and more to do with market psychology, capital flows, and investor attention. In the next clip, Lee explains why he remains broadly bullish despite recent volatility and why he believes some of the strongest opportunities may still lie ahead.
I know it's been a tough market for folks. I mean, I'm not surprised. We were kind of expecting 2026 to be a year where turbulence could happen and people would see head fakes, but there's still some really powerful tailwinds for America. One is, of course, the AI story. And now we're learning about the energy independence, right? America can deal with high oil because we're not going to have a shortage of it. And then there's further tailwinds coming because as AI moves downstream, it's really benefiting American businesses. I think that's why S&P earnings came in for just the first quarter $10 higher. That's $40 for the year. And if you just put a 20 multiple, that adds 800 points to the S&P. So I think there's a lot of grounding for why stocks are able to recover. So but again, I think we still might have challenges between now and December. So I think everyone still needs to be vigilant, but generally bullish. I think a couple things are coming together, Joe, that are going to really support a few things that may only happen like once in our lifetime. One is I think the U.S. economic growth rate is actually starting to step up. In other words, we could grow at 4%, and for a mature, largest economy in the world to start to accelerate growth, that's pretty astounding. The second is the U.S. is one of the biggest exporters of the most important tool in the next 10, 15 years, which is AI products. And that means we are a net, essentially, exporter of a high-value product. And there's so much capital, I think, misallocated today because so much of it is held in private alternatives, but it's going to move into the public market. So I do think that, plus the demographic tailwind of millennials and Gen Z adding to the workforce, but then also beginning to inherit generational wealth. I think that is going to set up for after 2026, perhaps, over the next 2 years, some of the biggest gains of the stock market in our lifetime. Our best guess, I think June markets can still build on the gains, just not at the rate that May did. And I think it is money moving downstream. So there's going to be software rallying and beneficiaries of AI. But between, let's say, June and October, we do have to digest potentially 3 major IPOs coming. And the market will try to understand Kevin Warsh's new sort of model for inflation. But I think the market always tests the new Fed. And then we have that normal seasonality around midterms. And so I think we could have a drawdown that'll feel like a bear market. And as you know, that February to April was just a 9% decline, but it felt like a crash. And so I think markets are going to really struggle if we start to have a drawdown. And then, of course, from October, I think that's when a very strong rally starts.
I don't know if you saw Mark Cuban said that he's now dumped or sold all of his Bitcoin, given that he no longer believes it's acting as a hedge against inflation or anything else. Argues gold has proven to be a better bet, and that Bitcoin has not acted the way it should if it's supposed to be digital gold. What say you?
Well, on the one hand, I think Mark is right. Crypto's been disappointing because crypto should move with, equity markets, and it should be rallying with software. Software has really started to rally big, and crypto hasn't moved. So I think there are what I call, quote, rage quitting, people selling here as if something is wrong. I mean, one, I think that's what always happens at the end of crypto winter. If someone asks me, is the thesis for Bitcoin or Ethereum broken? It's absolutely not, because one, the more work we do, and we're hearing it from founders like Palantir, Bitcoin and Ethereum are really the future of money, because mass and compute, or compute and energy, however Elon puts it, really are what's scarce. And you're going to need to control agent systems. And as AI systems evolve, right, we're now talking about using commerce and operating websites. You need decentralized identity and verification. That's really what crypto does. And we know Wall Street wants to go towards tokenization. It's a vast improvement in efficiency of actually how money moves. And it's an innovation. Well, that only happens on Bitcoin and Ethereum and other smart contracts. So the future isn't changed, but the spotlight today is, of course, on semis, memory, starting on software. But as people focus downstream into the future, that's really, I think, when the bid comes for Bitcoin and Ethereum. Market sentiment plays a huge role because it's sort of essentially risk premia. But there are two proven ways to value crypto. One, of course, is just network usage, because wallets and activity per wallet still explain, like, even now, 87% of the rise of Bitcoin. So as long as more people use it and they're transacting it, the value of Bitcoin should go up. It's a network effect. And the second is the umbrella value of gold. Gold when it hits 5,000, if Bitcoin had the same network value as gold, and gold is not as scarce as Bitcoin, that would put Bitcoin at around 2 million. So to me, I think there's still two ways to look at the value. And of course, for Ethereum, it's been shown for every dollar of tokenized assets, tokenized dollars or others, it's created $1 value for ETH, the coin. So if you believe Wall Street's going to tokenize, Ethereum's price should go up a lot.
Tom Lee's perspective offers an important reminder during periods of market stress. While investors are understandably focused on short-term price action, the larger trends driving both equities and digital assets may still be intact. According to Lee, artificial intelligence adoption, rising productivity, stronger economic growth, and increasing capital investment could create one of the most favorable environments for risk assets in decades. What's particularly interesting is his view on crypto's current underperformance. Rather than seeing weakness as evidence that the Bitcoin thesis has failed, Lee argues that crypto is simply not receiving the same level of attention currently flowing into AI-related stocks, semiconductors, software companies, and other beneficiaries of the artificial intelligence boom. In other words, the market spotlight has shifted temporarily, but the long-term case for Bitcoin, Ethereum, tokenization, and decentralized networks may be stronger than ever. That doesn't mean volatility is over. Bitcoin's drop below $70,000, the record ETF outflows, strategy's surprise sale, and ongoing geopolitical tensions all show that this remains an incredibly fragile market. More turbulence could easily be ahead, but as we've seen throughout crypto's history, some of the moments that feel the most uncomfortable often become the periods investors study years later. As always, none of this is financial advice. The goal is to understand what is happening, separate emotion from reality, and focus on the developments that truly matter. And before you go, let us know your thoughts in the comments. Do you believe Bitcoin's current weakness is a temporary shakeout, or are we entering a much deeper correction? If you found this breakdown valuable, please consider supporting the channel by leaving a like, subscribing, and turning on notifications. It genuinely helps us continue producing research-driven content and bringing you perspectives from some of the most influential voices in crypto, finance, and macroeconomics. Thank you so much for watching, and we'll see you in the next video.